Hello and welcome to this week's brief strategy session with me, David Jones, and Trading 212. I thought this week we'd go back to basics a bit, back to sort of some quite basic charting approaches to the markets. And we talk about breakouts, the idea of a market breaking either up or down from a range it's been in and how you can trade it. I think it's quite a popular trading strategy, maybe because it is so simple. Like lots of strategies, or all strategies, it doesn't work all the time. But I think there are certain things you can look out for, and maybe jumping on the breakout straight away isn't the right way of trading it. Maybe having a little bit of patience is the better way to trade breakouts. But it's all about when a market's stuck in a range and suddenly it starts to move out of that range. What should we do? Let's take a look, first of all, as usual, at our theoretical market and go through some of the ideas from a textbook point of view as to how we can trade breakouts. So let's take a look at the theory behind breakouts. So here we've got a market that's been trading sideways. Up here we have resistance, a level the market hasn't been able to get through, and down here we have our support. When the market slides, the buyers are coming back in. So these are the levels we're watching to see if a breakout happens. So the market starts to move back up to the old resistance, backs away, but then we have this. It moves through, so it's breaking through a level that's been a problem in the past. So this can be a sign that maybe sentiment is changing. So this really is our breakout point. Now from here, it's easy to spot these things, but when it comes to trading them, like so many theoretical examples, I think it can be a little bit trickier because there's at least three things that can happen here. So the question is, do we just buy the first breakout because we're expecting the market to just take off? What could also happen, the market moves higher, but then moves back a little bit before moving higher again. So another strategy is to wait for the pullback, wait for the market to pull back after that initial breakout. When it turns around again, look to buy in and place our stop loss somewhere like that. The other risk is that this happens. Market rallies up and then just pulls back into the zone. So that's a false breakout. So I think it's important to demonstrate, like with most things in trading, nothing works all the time, but a breakout can be a sign that sentiment is shifting, and it's all about how you trade it. Personally, I'd rather wait to see for the pullback and then for the market to carry on in the direction of the breakout, because it gives maybe a better level for when it comes to placing a stop loss. When it comes to breakouts to the downside, of course they're the same. The market hits support, rallies maybe, and then boom, breaks through. So that would be the signal that the breakout is happening. Then after that, it's just deciding, well, how am I going to trade this potential move? So as ever, that's the textbook view. We'll now take a look at a couple of real markets, a longer term example and a shorter term example, to see how you might trade this in the real world. Just to show that breakouts can happen over all sorts of time frames. This is a really long term one. This is the electric car company, Tesla Motors, trades in the US. And you can see, if we go back to here, the shares hit a high August 2014, trading up to around about $292 a share. They came back to it almost a year later in the summer of 2015, and they sold, so we have this definite resistance. And then once again, beginning of this year, February 2017, back up to that 292 level, and the sellers backed away. So clearly, what the market's telling us here is that it thinks at 292, Tesla shares are too expensive. So we have a definite level to watch to see if there is going to be a breakout. Let's just go forward in time to see what happened next. I've changed this now to a daily candlestick chart from the weekly candlestick we were on previously. You can still see that 292 level. As we scroll forward, you can see that here it starts to break out. So beginning of April, it breaks above that 292 level. So some people might be buyers now, thinking that sentiment has changed. It does dip back a little bit over the next couple of days and hovers around the old breakout before continuing sideways and then moving higher, pushing out following that breakout. So it went from 292 up to just shy of the $390 a share level. So that's an example of a breakout in a longer term time frame. And as of last week, it was coming back to that old breakout level. Here's a shorter term example. We're looking at here oil from the beginning of July. So the price of oil had rallied higher from the end of June, below $44 a barrel, up as high as just above $47 a barrel. So we've got a clear uptrend in place. Along the way, we'd had the odd dip. The market dipped back here, the 3rd of July, down to $46.68. Then over the next few hours, rallied a bit, came back again to 46.70. So these are hourly candlesticks we're looking at. So that's a support level to watch. So we're assuming if the market dips back down to here, we're going to see buyers come back in. But if the market starts to fall below that level, once again, we've got a breakout of a short-term level, but a breakout of support nonetheless. Let's just move forward in time to see what happens next. So on this hourly candlestick, you can see we've got quite a big range in that hour. So that level gets broken. So we've got the start of a breakout. The only question, if you're going to trade a breakout like this, is do you jump on the breakout straight away, or do you wait for a pullback to see what happens next? So the price of oil does pull back a little bit over the next 2 or 3 hours, but eventually the market does move lower. So I think these breakouts, they're easy to spot in hindsight. They can be quite difficult to trade because it's all about, do you jump in right at the start, or do you wait to see if the market comes back so you've got a better level to set your stop loss. But it's something that we see across all sorts of different markets. There we go, 2 very different markets there, but the psychology behind breakouts and different ways of trading them is broadly the same, whether we're looking at a share, a currency, long-term, short-term, medium-term. So I hope this has given you maybe a few ideas about how you might want to adapt it into your own trading strategy. We'll wrap things up there, but as usual, if you're not subscribed, if you click on the subscribe button, you'll get notified when the next video gets uploaded. If you like the video, click the thumbs up at the bottom. And if you'd like us to cover anything in the future, we do read all the messages, so just leave us a note in the comments down below. But for this week's strategy video, we'll leave it there. That's from me, David Jones, and Trading 2 on 2, and I hope you have a good trading week.